Welcome back to the podcast, Generate Income by Selling Options. In the previous episode, we talked about covered calls. Let's now dive into the other side of the coin, which is cash secured puts. In this episode, our podcasters will chat about what cash secured puts are and how you can use it to generate income. So, with that said, let's bring in our host to dive into cash secured puts. And as a reminder, please subscribe to this podcast channel in order to stay updated on upcoming episodes. Take it away, Adam and Isla.
Welcome back to the deep dive. Today, we're going to be looking at cash-secured puts,
Ooh, cash secured puts.
a strategy that I think intrigues a lot of listeners.
For sure.
And we've got a pretty robust stack of articles and research
Nice.
from places like SoFi, Investopedia, E-Trade, Tasty Live,
Wow.
even the folks over at Charles Schwab Fidelity and the Options Playbook.
That's a lot of material.
Yeah, so think of this deep dive as your shortcut to really understanding this options strategy,
Okay.
going beyond just the mechanics.
All right, I'm ready.
Awesome.
You know, it's interesting. When I was first getting started with options, cash secured puts were one of the first strategies I really dove into. There's this element of control,
Okay.
of being able to utilize time to your advantage that I found really appealing.
I see what you mean.
Yeah.
It almost feels like you're getting paid to wait for a buying opportunity. Instead of just placing a limit order, you're generating income while you see if the stock hits your target price. But before we get too far ahead of ourselves, let's make sure everyone is on the same page. Can you give us a quick rundown of the core concept behind cash-secured puts?
Absolutely.
Awesome.
At its heart, a cash-secured put involves selling a put option on a stock while simultaneously setting aside enough cash to buy those shares if the option buyer decides to exercise their right. It's called cash-secured because you're literally backing up your obligation with cold, hard cash.
Okay, so let's say I'm interested in potentially buying shares of a company. Let's call it TechCo.
All right.
But I think the price might drop a bit in the short term.
Okay.
I could sell a put option on TechCo with a strike price that represents my ideal entry point. Is that right?
Yes. You're essentially giving someone else the right but not the obligation to sell you 100 shares of TechCo at that specific strike price.
Okay.
And in exchange for taking on that obligation, you receive a premium upfront.
Now, I remember from some of our past deep dives that options contracts can be a bit tricky.
Oh, yeah, for sure.
It's not just about whether the stock goes up or down.
Right.
There's the time decay element, implied volatility.
Absolutely.
It can get complex.
Uh-huh.
How does all of that play into a cash-secured put strategy?
That's a great point.
Yeah.
One of the key things to understand is that time decay works in your favor as a put seller.
Okay.
As the option gets closer to its expiration date, the value of the put erodes, assuming all other things stay the same, and you keep that portion of the premium that decays away.
That's interesting. So even if the stock price doesn't move much, you're still making money as time passes.
You got it.
What about implied volatility? How does that impact my decisions when selling cash-secured puts?
Implied volatility is a big one.
Okay.
Remember, it represents the market's expectation of how much a stock's price is likely to fluctuate.
Huh?
High implied volatility generally leads to higher option premiums, which can be tempting for a put seller.
So it's like getting paid more for taking on more risk.
Right.
But how do I know if that risk is worth taking? I mean, I'm comfortable with options. I'm not trying to gamble here.
Exactly. You're not in the casino.
Right.
That's where careful stock selection and research come in.
Uh-huh.
If you believe a stock's implied volatility is artificially high, meaning the market is overestimating the potential for big price swings, selling a cash-secured put could offer a favorable risk-reward profile.
So it's about identifying situations where the market might be a little too fearful.
Yeah.
And you're essentially saying, I'm willing to buy at this price if it drops that low.
That's a great way to put it. But let's be real, there's always the chance you could be wrong.
Right.
That's why understanding the potential downsides of this strategy is just as important as understanding the potential rewards.
Right, because it's not all sunshine and roses.
No.
We know there's the obligation to buy the stock if it falls below the strike price. Let's talk about that a little bit.
Okay.
What's the worst case scenario here?
Well, technically the worst case scenario is that the company goes bankrupt and the stock price goes to zero.
Oh, wow.
It's rare, but it can happen.
Okay, so in that situation, even though I collected a premium up front, I'm essentially out the entire strike price multiplied by 100 shares.
Yeah.
That's significant loss.
Yes, it is.
Yeah.
And that's why it's critical to only sell cash-secured puts on companies you've thoroughly researched and believe in for the long term.
Okay.
It's not just about the premium. It's about being comfortable owning the stock at the strike price.
That's a good reminder.
Yeah.
So it's not just about chasing the highest premiums.
Right.
It's about finding a price point where you're happy to become a shareholder.
Exactly. Think of it like this. You're essentially setting a limit order with the added benefit of getting paid while you wait.
And this is where understanding your risk tolerance really comes into play, right?
Absolutely. Position sizing is crucial here.
Okay.
You don't want to tie up so much capital in a single cash-secured put that a potential loss would derail your entire portfolio.
Mm-hmm.
It's about finding the right balance between potential reward and the risk you're comfortable taking.
Okay, so we've covered the basic mechanics, the importance of implied volatility and risk tolerance.
Yeah.
But I'm curious, once I've sold a cash-secured put, what are my options for managing that position as the expiration date approaches?
Okay.
Do I just sit back and wait?
You actually have a few different choices.
It sounds like there's a lot more to unpack here.
There is. It's not just about the initial trade.
Okay.
It's about how you manage it over time.
Mm-hmm. We talked about the setup.
Uh-huh.
Now I want to understand how to actively manage these positions.
Okay.
You mentioned there are different choices. So let's walk through them. What are my options once that put is sold?
Well, the most straightforward approach is to simply let the put expire worthless.
Okay.
If the stock price stays above the strike price, the buyer won't exercise their right, and you get to keep the entire premium.
That sounds almost too easy.
Yeah.
So I just pocket the premium and move on. What's the catch?
There's no real catch.
Okay.
But remember, your potential profit is capped at the premium you received.
Okay.
If the stock skyrockets, you miss out on those gains.
I see. It's like selling your upside potential in exchange for that premium and the possibility of buying the stock at your target price.
That's a good way to think about it.
Yeah.
It's a trade-off. Cash-secured puts are best when you're neutral to bullish, not when you're expecting a massive rally.
Okay, so what happens if the stock price does dip below the strike price and the put buyer decides to exercise their right?
Yep.
I'm guessing
Yeah.
this is where that cash I set aside comes into play.
Exactly. You get assigned the stock, meaning you're obligated to buy 100 shares at the strike price.
Okay.
Since you already have the cash ready, the transaction happens automatically.
So in this scenario, I end up owning the stock at my desired price, and I've already pocketed some premium.
You're right.
Not a bad outcome, especially if I was planning to buy the stock anyway.
Right. It's like getting a discount on a purchase you were already going to make.
I like that.
But there's another scenario we need to consider. What if the stock drops significantly below the strike price?
Let's talk about that. Say I sold a put with the strike price of $50.
Okay.
Collected my premium, but then the stock takes a nosedive down to $30.
Right.
What happens then?
Well, you'd still be obligated to buy those shares at $50 each, even though they're now trading much lower. That's
Yeah.
the risk you assume as a put seller.
Okay, so even though I collected some premium up front, I'm still looking at a paper loss in this situation.
Right.
What options do I have at that point?
One approach is to simply hold the shares and wait for a rebound. Remember, you chose that strike price because you believed in the company's long-term prospects.
Right.
This is where your initial research and conviction really matter.
So it's not just a mechanical strategy.
No.
There's a fundamental analysis element as well.
Absolutely. But sometimes holding and hoping isn't the best course of action.
Yeah.
Especially if new information emerges that changes your outlook on the company. What other options would you have in this situation?
Well, I could sell covered calls against my shares to generate additional income and potentially reduce my cost basis.
Yep.
Or I could simply sell the shares at a loss and move on.
Right.
But is there anything I could do before assignment
Yeah.
to potentially avoid owning those shares at an unfavorable price?
Yes, there is. You can buy back the put option to close your position before expiration or assignment.
Okay.
The price you pay to buy back the put will depend on several factors, including how far the stock price has moved and how much time is left until expiration.
So it's like an exit strategy. If I get uncomfortable with the potential loss, I could essentially buy my way out of the obligation. But how do I decide when to do that? It seems like there's a lot of judgment involved.
There is. It's all about risk management and understanding your personal tolerance for potential losses.
Okay.
You might set a predetermined stop-loss level where you automatically buy back the put if the stock drops below a certain point.
Okay.
Or you might use technical analysis to identify key support levels where you'd consider closing the position.
So it's not just about setting it and forgetting it.
No.
There's this active management component that can make it a bit more complex.
Right.
What about delta? We talked about that earlier.
Uh-huh.
How does understanding delta help me manage a cash-secured put position?
Delta is a great tool for assessing the probability of assignment.
Okay.
It tells you how much the option price is expected to move for every $1 change in the underlying stock price. By monitoring delta, you can get a sense of how likely you are to be assigned those shares.
Okay. So delta is like a risk gauge.
Yeah.
That gives me some insight into the potential for assignment. Sounds like there are a lot of moving parts to consider when managing cash-secured puts.
There are.
How do I know which approach is right for me?
That's a great question. And honestly, there's no one-size-fits-all answer.
Okay.
It depends on your individual investment goals, risk tolerance, and outlook on the underlying stock.
I'm starting to sense a theme here.
Yeah.
It's all about personalization and finding the right strategy for your specific circumstances.
You got it. Options trading and cash-secured puts in particular offers a lot of flexibility. But that flexibility comes with the responsibility of making informed decisions based on your individual needs and goals.
This is fascinating stuff. We've covered the different management options from letting the put expire worthless to buying it back, the role of delta in assessing risk, and the importance of fundamental and technical analysis. But I'm wondering, are there any specific situations where cash-secured puts might be particularly well suited? Or situations where I should absolutely avoid them?
That's a great segue into our next topic. Suitability.
All right, let's talk suitability.
Okay.
Who should steer clear of cash-secured puts?
Well, if you're bearish on a stock, meaning you expect the price to go down, cash-secured puts are definitely not the right strategy.
Okay.
Remember, you're essentially betting that the price will stay above the strike price.
Right.
If you think it's headed south, you're setting yourself up for potential losses.
That makes sense.
Yeah.
It's not a strategy for someone looking to capitalize on a decline.
Right.
What about risk tolerance? How much risk am I taking on with a cash-secured put?
The risk is theoretically limited to the strike price multiplied by 100 minus the premium you received. However, that doesn't mean it's a low-risk strategy.
Gotcha.
You need to be comfortable with the possibility of tying up a significant amount of capital and potentially owning a lot of shares if the stock price drops.
This is not for the faint of heart.
Right. And if you're looking for quick, short-term gains, cash-secured puts might not be the best fit either.
Okay.
This strategy is generally more suited for investors with a medium to long-term outlook who are comfortable with the potential for price fluctuations along the way.
Okay, so we've established who should avoid cash-secured puts. But on the flip side, who might find this strategy particularly attractive?
Well, investors who are bullish or neutral on a stock but believe it might experience a short-term dip could find cash-secured puts appealing.
Okay.
It allows them to generate income while they wait for a potential buying opportunity.
Yeah.
And if they end up owning the shares, they've effectively purchased them at a discount.
It's like getting paid to be patient.
It's also a good strategy for investors who are comfortable with the risk of owning the stock but want to potentially lower their cost basis.
So if I'm already planning to buy the stock anyway,
Yeah.
selling a cash-secured put could be a way to enhance my potential returns.
Exactly. And remember, even if you don't want to own the shares, you can always buy back the put option before assignment to close your position.
Right. That flexibility is a big advantage. But what about alternative strategies? If cash-secured puts aren't the right fit for me, what else is out there?
That depends on your specific goals and risk appetite.
Okay. Hit me with some options, so to speak.
Well, if you're bullish on a stock but you don't want to tie up a lot of capital, you might consider buying call options.
Okay.
Those give you the right but not the obligation to buy shares at a set price.
So instead of promising to buy, I'm buying the right to buy.
Exactly.
Kind of flips the script.
And if you're looking for income generation but you're not comfortable with the potential obligation of owning shares, you could explore covered calls. That involves selling call options on stocks you already own.
Okay, so covered calls are like the opposite of cash-secured puts.
Yep.
Instead of potentially buying shares, I'm potentially selling shares I already have.
You got it. And there are countless other option strategies out there, each with its own unique set of risks and rewards. We could do a whole deep dive on just that topic.
I have a feeling we will at some point.
For sure.
But for now, I think we've covered a lot of ground with cash-secured puts.
We have. It's a versatile strategy with a lot to offer,
Yeah,
but it's not a magic bullet.
right.
It requires careful planning, thoughtful consideration, and a good understanding of the underlying stock and the options market.
All right, so let's recap the key takeaways for our listeners. What are the most important things to remember about cash-secured puts?
I think one of the most important takeaways is that cash-secured puts are not a get-rich-quick scheme. It's a strategy that requires patience, discipline, and a willingness to learn and adapt.
Right, it's about understanding the mechanics, but also about managing risk and making informed decisions based on your individual circumstances.
Yeah.
What else should our listeners keep in mind?
I'd say another key takeaway is that cash-secured puts are best suited for investors who are neutral to bullish on the underlying stock
Uh-huh.
and are comfortable with the risk of potentially owning those shares. It's not a strategy for everyone, and it's crucial to do your research and understand the potential downsides before diving in.
Solid advice.
I think the most important thing is to continue learning and exploring.
Okay.
Options trading can be a powerful tool for enhancing your investment strategy, but it takes time and effort to master.
Yeah.
There are so many resources available online, in books, and through communities of traders.
Right.
Don't be afraid to ask questions and seek guidance from experienced investors.
That's a great reminder. It's all about continuous learning and improvement.
For sure.
Well, we've covered a lot of ground in this episode.
We have.
But there's one final piece of the puzzle we need to address. Taxes.
Yes. The ever-present topic of taxes.
Right.
Taxes.
The tax man.
The tax man.
I was going to think about taxes. Right. The often overlooked but always important consideration in any investment strategy.
Right.
So let's break it down.
Okay.
What are the key tax implications I need to be aware of when trading cash-secured puts?
Well, the good news is that the tax treatment is fairly straightforward. The premiums you receive from selling puts are considered short-term capital gains, regardless of how long you hold the position.
Okay, so even if I hold the put for a year or more, the premium is still taxed at my ordinary income tax rate.
That's right. Now, if you're assigned the stock and decide to hold it for more than a year, before selling, any profits from that sale would be taxed as long-term capital gains.
So there's a potential tax advantage if I end up owning the shares and holding them for the long term. But what about losses? How are those treated from a tax perspective?
Losses from selling puts are treated as short-term capital losses. You can use those losses to offset other capital gains you might have realized during the year, which can help reduce your overall tax liability.
So there's a bit of a silver lining if things don't go as planned.
Exactly.
But I have a feeling it can get a bit more complex than that.
Oh, yeah.
Especially if I'm actively managing my positions, rolling puts, or adjusting my strategy.
Right. Things can get more complicated, especially if you're implementing advanced option strategies. That's why it's essential to keep detailed records of all your trades, including the dates, strike prices, premiums received, and any adjustments you make.
So having a good trading journal or software that tracks all this information is critical.
Absolutely. And it's always a good idea to consult with a qualified tax professional
Right.
who can help you navigate the specific tax implications of your options trading activity.
Right.
They can guide you on things like wash sale rules, which can come into play if you sell a put for a loss and then buy back the same, or a substantially similar option within a certain time frame.
Okay, that's a good reminder.
Yeah.
Taxes can be tricky, especially when it comes to options.
Yeah.
But before we wrap things up entirely, I want to go back to something we touched on earlier.
All right.
This idea of using time to your advantage.
Yeah.
We talked about how cash-secured puts can be a way to get paid while you wait to buy a stock, but I think there's a broader principle at play here.
You're spot on. Time is one of the most powerful forces in investing. And it's something that's often overlooked. We tend to get caught up in the short-term noise, the daily price fluctuations, the latest headlines.
Right.
But the real magic happens when we shift our perspective and embrace a longer-term view.
So how can our listeners who are clearly interested in leveling up their investment game start to think differently about time in their own strategies?
One way is to focus on the power of compounding.
Okay.
The longer you allow your investments to grow, the more those gains can compound upon themselves, creating a snowball effect over time. It's like planting a tree.
Yeah.
The early years might seem slow, but the growth becomes exponential as the years go by.
It's that classic saying, the best time to plant a tree was 20 years ago. The second best time is today.
Exactly. Another way to leverage time is to embrace patience.
Okay.
The market is inherently cyclical. There will be ups and downs. But by staying the course and resisting the urge to react emotionally to short-term fluctuations, you give your investments the opportunity to ride out those cycles and come out stronger on the other side.
That's easier said than done, especially in today's fast-paced world.
Oh, yeah.
But it's a powerful reminder that investing is a marathon, not a sprint.
Absolutely. And finally, I'd encourage our listeners to think about time, not just in terms of holding periods, but also in terms of continuous learning and improvement.
Okay.
The more time you invest in expanding your knowledge, honing your skills, and refining your strategy,
Yeah.
the better equipped you'll be to navigate the ever-evolving world of investing.
That's a great point. It's not a one-and-done process. It's about constantly seeking out new information, challenging your assumptions, and staying ahead of the curve.
Couldn't have said it better myself.
Well, this has been an incredibly insightful deep dive into cash-secured puts.
It has.
From the mechanics to the management, the tax implications, and even broader philosophical considerations about the role of time in investing. I always learn so much from these conversations.
Until next time.
We'll see you on the next deep dive. And make sure you subscribe to this podcast and follow us on X to be notified of our next podcast episode. Just click on that follow or subscribe button. Our X handle is the @ symbol, following by selling, the number 4, premium. All one word.